All right, let's cut right through the noise. In the next few minutes, we are going to build a truly resilient investment portfolio for 2026. You know, the old playbook of just chasing whatever's hot, that's starting to look pretty shaky. So we're going to use some expert analysis to put together a new one, focused entirely on quality and stability. Let's dive in.
Here's how we'll do it. First, we'll unpack the big puzzle every investor is facing right now. Then, we'll talk about this major strategic shift towards quality and the three big market pillars that are holding it up. And finally, we get to the good part. We'll put it all into practice, building a 7-stock portfolio and breaking down exactly why each company earned its spot.
Okay, so let's start with the central challenge for all of us right now. We're trying to navigate this landscape where these huge, powerful growth drivers are smashing right up against some pretty significant economic risks.
I mean, on the one hand, you've got this AI supercycle, right? It's a force so massive, it feels like it's single-handedly propping up the entire global economy. But on the other hand, it's fighting some serious headwinds. We're talking tariffs, stubborn inflation, and kind of sluggish growth. It really creates this intense tug-of-war for investors.
And this quote from JPMorgan just nails the feeling perfectly. The signals are, well, they're all over the place. Growth isn't falling off a cliff, but it's not taking off either. Inflation is still that annoying problem that just won't go away. So, for anyone trying to position themselves for 2026, this muddled picture makes taking those big, concentrated bets feel incredibly risky.
So, how do you solve a puzzle like this? Well, the consensus from our sources points to a really crucial strategic pivot, a move away from chasing pure momentum and towards something way more durable.
And this is the big idea: quality-first investing. Look, this isn't about finding the next meme stock. It's about identifying incredibly robust businesses that are built to weather economic storms. We're talking about companies with rock-solid financials, consistent earnings, and, crucially, companies that are plugged into those long-term unstoppable trends like AI.
This slide really gets to the heart of the shift and how the market is behaving. The last few years felt very winner-takes-all, didn't they? A few big names just soared. But the forecast for 2026 points to a winner-takes-some kind of world. And in that landscape, strategic resilience and solid fundamentals are going to matter way, way more than just riding the latest wave. Now, this shift isn't just a gut feeling. It's actually built on three very distinct pillars that are expected to define the market in 2026. Let's take a look at the evidence.
So the three pillars are these. First, the AI build-out is still going strong. Second, there's a real need for resilience in a world that feels like it's getting more fragmented. And third, we're seeing this renewed appreciation for good old-fashioned diversification as market leadership starts to spread out a bit.
First off, that AI supercycle, it is not slowing down. iShares is forecasting an absolutely mind-boggling $5 to $8 trillion in infrastructure spending by 2030. This isn't just a bubble, folks. It's a fundamental economic shift that provides a huge, long-term tailwind for the companies that are powering it.
And this chart from Morgan Stanley does a fantastic job of illustrating that third pillar. Yeah, tech growth is still solid, but look at how that earnings growth gap is closing. You've got cyclical and defensive sectors that are really bouncing back. What this tells us is that the market is broadening. A portfolio that's only concentrated in tech is going to miss the bigger picture.
Okay, we've defined the problem, we've laid out the strategy, now it's time to put it all together. Let's build a concrete portfolio that's designed to maximize our gains while minimizing the risk in this totally new environment.
So here it is, a 7-stock portfolio engineered from the ground up for quality and resilience. You'll notice right away the diversification across some really key defensive and cyclical sectors. So now let's break down the why. Why did these specific companies earn a spot?
So let's do a quick lightning round for each one. Let's see how each company fits perfectly into our quality-first framework. This is where the strategy really becomes reality.
We're going to start with JPMorgan Chase, the absolute financial anchor of this portfolio. We're talking a projected $57 billion in net income and a 20% return on tangible common equity, which is a huge measure of profitability. JPM is the very definition of a fortress balance sheet, built to withstand just about any economic storm.
Next up, NextEra Energy. Now, I want you to think of this as less of a simple utility company and more of a direct play on that AI supercycle we talked about. They provide the massive amounts of power that data centers need. And here's the key part. With a beta of just 0.38, it gives you that AI exposure with way less volatility than the overall market. That makes it a fantastic stabilizing force.
Now, for a strategic resilience pillar, we've got Lockheed Martin. I mean, in a world that feels more and more fragmented, rising defense spending creates this powerful, non-cyclical tailwind. But even more importantly, its huge backlog of orders gives it incredible revenue predictability. It's a really reliable hedge against wider economic uncertainty.
And for that classic defensive stability, we've got Johnson & Johnson. With a solid dividend, a proven history of durable earnings, and an impressive 33% return on equity, J&J is exactly the kind of high-quality business that adds some much-needed ballast to a portfolio when things get choppy.
UnitedHealthcare Group is another healthcare giant, but it's also kind of a stealth AI play. It's using data and AI to drive massive efficiencies across its $435 billion revenue stream. And with a forward PE multiple under 15, it gives you exposure to both quality and growth at a really reasonable price.
To anchor our exposure to the consumer, we turn to Walmart. Its dominant market position and its laser focus on staples, that creates a powerful economic moat. I mean, no matter what the economy is doing, people need to buy what Walmart sells, and that provides fantastic stability for the portfolio.
And last but not least, Procter & Gamble. PG is just the epitome of a quality company. Its portfolio of absolutely iconic brands gives it pricing power, and its long history of consistent dividend growth makes it a super reliable compounder for any long-term portfolio.
So let's wrap all of this up with the single most important takeaway from this whole analysis of the 2026 market.
Here's the bottom line. The game is changing. Chasing those high-flying momentum stocks from the past couple of years, that's a really risky strategy for the road ahead. The mandate for 2026 is crystal clear. Own the highest quality, most resilient businesses that can compound your wealth through the entire economic cycle.
And that really just leaves us with one final question for you to think about. As this market shifts into a winner-takes-some world, I want you to take a really hard look at your own holdings. Are they truly built for resilience? Or are they just a bet that yesterday's momentum is going to last forever?